Welcome back to the Williams Real Estate Channel. Today we are running through the macro market update for May 2025. So to kick it off, we will touch on the Australian GDP growth rate is currently tracking as of December 2024 at 1.3%. So low in terms of historical averages. Usually it's around that 3%, ideally, if it's even higher, like what we saw in the boom after the COVID recession, where a lot of demand bursted out after the lockdowns. That was, I guess, out of season. And since then, we have been trending south, and it has been rather sluggish in recent years. So ideally, you want to see the GDP rate above the inflation rate, meaning if we're growing as an economy, the Australian economy, and you can afford the higher inflation, you don't want it the other way around, where inflation is currently higher than our GDP. So essentially, we're not growing because the growth rate is less and the cost of goods and services is higher. We're essentially going backwards. So it will recalibrate in the years ahead, I believe. Once the market sets through the next land-driven downturn, inflation will come right back down again and then sit in a more balanced band, in the 2.5% band, under 2%, ideally, and having GDP above 3. So it is trending that way, where we see inflation is coming down. As of the latest data out, the trim mean inflation is sitting at 2.9%, and the all groups is just in to the band of 2.4%. So we are heading in the right direction, and unemployment is remaining rather tight at 4.1%. So consistently holding that mark. It did come off a little bit of a record levels in 2023 and 24, and is since holding steady at 4.1. So is still relatively low, and based off the RBA's commentary, it is quite tight still. So a good indicator that we are keeping an eye on. If this starts to run higher, it'll definitely illustrate that we're entering the next land-driven downturn. The RBA dropped the cash rate during May to 3.85%, and their key notes out of their statement was saying that they believe the risk to high inflation is becoming more balanced. Inflation is now expected to sit within the band, the 2 to 3% band, as it's now just scraped in at 2.9%, but they're expecting it over the next coming months and years to be maintained within that 2 to 3%, which is good. The risk is now shifted to away from high inflation being a risk to being more moderate, and now the risk and the commentary is around the US tariffs, as these tariffs could slow the global economy along with Australian economy, and it is still uncertain times to see where we'll exactly land in terms of these tariffs. Trump seems to put them on, put them off, use them as more of a negotiation tactic. So we'll have to see how that all plays out. But this is on the key agenda now for the RBA. Wages are rising, unemployment's tight, and employment is growing. So it gave them enough confidence to drop the cash rate, meaning that inflation is now within the band. We are in a strong position where we're talking the employment stats, and they made note that they did consider the options if we are to enter a downturn, and they said that they have plenty of room to drop rates further. So that can give you, I guess, a feel for there are more potential rate cuts during the rest of this year, and we'll have to see how that plays out in terms of the market. I can already feel that confidence is back. It is um, becoming more and more of a seller's market in certain regions, especially the likes of Brisbane, Perth, Adelaide. They're all charging. But even the likes of, say, Sydney and Melbourne are now becoming more of a balanced market rather than, say, in 2024. They were definitely in a slump. In 2023, in a slump. They have now started to pick up a bit. And it could be driven by this confidence, this reassurance now that people see rates are now heading down and they've more or less hit a ceiling of where they may go. So what I thought was interesting and what hasn't been quite covered by any mainstream media yet, in the US, the GDP growth rate dipped into negative this first quarter for 2025, negative 0.2%. So 2 quarters of negative growth, like what happened in 2020, is a recession, technical recession. So if we see another quarter, the US would be technically entering a recession. So see how this all plays out. It may be short-lived, just like the dip the market saw in 2022. Potentially, I believe that could be the case. We're not due for the next downturn yet. There's still a good 12 months to 18 months to run in this current cycle. But I did think it was quite interesting to see that there has been a bit of a pullback, but I think it will be short-lived. The United States inflation rate is also trending down, is down to 2.3% as of April. They do have a target band of 2%, so a target rate of less than 2. They don't have a band like in Australia of 2 to 3%. So their target is a lot tighter. Hence, the Federal Reserve, Jerome Powell, is still holding rates pretty high. Consider this inflation data along with the GDP dropping into negative. It is actually quite surprising that the Fed is still maintaining rates higher. They have the unemployment rate tick up 0.1% to 4.2%. So it is slowly trending up. And this is a key thing to keep an eye on, because once it starts to trend up, it never tends to go back down again, and it'll only gather momentum. And then that'll ultimately be a leading indicator for the next downturn. We keep a big eye on the US as the US leads the global markets. And as I said before, the Federal Reserve is still holding the cash rate at 4.5%, even with a negative quarter of GDP and pretty low inflation. So Trump is getting the shits. He's talking about not renewing his term come early next year. I think it's between March or May 2026 where his term will be up. And I suspect Trump will probably replace him with someone that will do what he says and try and drop rates as quick as possible. He's a real estate guy. He wants low rates. Low rates makes assets inflate in value and cash flow better. He wants low rates. Low rates also makes the economy look like it's better than it is, as people will be borrowing more credit, putting it into the markets. The markets will be pumping in the final winner's curse, the final top as we enter 2026 and late 26, early 27 is when the markets are due to top out. Stock markets are coming back after their quick, short, sharp-lived correction. Trump and his trade policies, his tariffs was spooking the markets, and we've already nearly recovered in Australia, It hit an all-time high of around 8,500 points. We're up to 8,400 points. So by the year's end, Australia, the US, and the UK, these stock markets will all be hitting all-time highs. As we are now in the land boom segment of the 18-year land cycle, this is all going to feed on itself. Confidence is coming back. The euphoria, speculation, final boom, which is what we see towards the tail end of a market top, is all starting to come in formation now as we speak in front of our eyes. Bitcoin, again, is nearly or hitting all-time high. So the speculation, all the punters are coming out of the woodworks again. Everyone's charging in, and it is all starting to feed on itself. And when you see the likes of 5.1 billion or $1.4 billion projects in Dubai, biggest, best projects, largest funded type of projects in the world, when all this starts to arise, you know we are reaching a market top where credit becomes easier. They need to keep building higher to make it feasible, make projects feasible. Land prices so high, you need to build extravagant, massive projects to make a margin. So this is what typically happens towards the tail end of the 18-year land cycle. We see massive projects like this getting thrown up left, right, and centre. However, in the background, we have D.R. Horton, which is the largest land and home builder or house and land package builder, developer, land developer with houses. So they buy large institutional land holdings, subdivide and put the road services in, and build the houses and sell the houses. A land developer, a land and property developer. History shows, and based off what happened this time last cycle, was that their share price fell over 65%, 66% from the peak in mid 2005. So July 2005, lost 60%, 66% from its peak in mid 2005, all the way to October 2007. So October 2007 was when the overall market topped out before the GFC. So back then in 2005 to October 2007, this stock price lost 66% as it was pricing in future reduced earnings as land price was falling on their projects. So this was a leading indicator at the time for the GFC, the global financial crisis collapse, come 2008 or late 2007, early 2008. D.R. Horton lost 66% over 26 years to October 2007, so before the entire market topped out. So today, you can see that it has lost 38% over 8 months from its peak in September 2024. Here we are again. So based off history, based off the 18-year land cycle, based off land prices already softening, not just in the US, but in regional New South Wales, regional Victoria, these markets are already starting to fall. They're in a downturn. It'll start again flowing from the regions, and the ripple effect will come back towards the likes of Sydney and Melbourne. But this leading indicator that I like to keep an eye on is 8 months in. So using historical frameworks, we can expect the market to top out late 2026. So come June, July, it could be any time. next year. So 12, 18 months away is when we can expect the market to top out. Come 2027, I believe it'll become well mainstream that we've entered the next land-driven downturn, where we'll see the stock markets absolutely get hammered. So they'll lose easy 50%. And we're already seeing now the Australian stock market has a PE ratio of over 18. So it's getting up there. It's getting pretty expensive. So it'll have probably another good, 20, 30 odd percent growth. But once we enter 2027, the markets could easily lose 50%. That being the Australian stock markets, US stock markets, UK stock markets, just like what happened from 2007 to 2008-9. Crypto, that stuff could probably get wiped out. Who knows? It's never been tested. So grab your popcorn and get ready to see the absolute catastrophe unfold. The likes of Darwin, WA, regional South Australia will maybe have another year or two worth of growth, as those markets being Darwin, WA, and regional Queensland have a dependency on the mining sector, so they will potentially get another few years of sugar hit. But come later in the decade, they'll be well entering the downturn. Regional South Australia will be entering a downturn by 27, 28, along with the likes of Brisbane, Perth, and Adelaide. However, the market will then shift, the demand will then shift, the ripple effect will come back to the likes of Sydney, Melbourne, and Sydney and Melbourne will then lead again in the recovery, just like what they did between 2006, 7 and onwards for a solid 10 years of bull run. So hence why we are sowing our seeds now in these markets in preparation for the next growth run. And then as the market then plays out next cycle, people then decentralize out into their respective regions and we continue to keep carrying on. Hope you enjoyed that. As always, this is by no means financial advice, but if you need help buying an investment property and building a long-term sustainable portfolio within the framework of the 18-year land cycle, I can help you. Shoot me an email. I can help you of where you are, where you're trying to get to. If you've already got properties and you're unsure of what to do as we enter the next land-driven downturn, we can get on a strategy call. I can run reports. I can show you where they sit. I can show you where they could potentially be heading based off historical data. Personally, I'm starting to offload a couple of properties. I'm selling a house out of Tamworth. I'm going to get a couple of townhouses on the market come 2026, early 26. I'm timing it around tax. You don't want to sell too many properties in 1 year as you get slugged. But I am probably going to offload 3 to 4 properties over the next 12 to 18 months to then reinvest the capital into larger assets like blocks of units in the likes of Sydney, Melbourne, and some regions that are primed for the next growth run. As it's like playing Monopoly. Buy 3 or 4 greenhouses, sell them off, move them into a hotel. Basically, buy a couple of houses and then roll the capital if you're refinancing, or you may sell down to reinvest into blocks of units. Ultimately, you want to land in blocks of units. It's the best of both worlds. You get the full land holding component, you get the good cash flow, you get the value add by strata title. You can buy them in a suppressed market, hold them through, get a solid cash flow through their growth run. They double in value. You can turn over the tenants, freshen them up, boost the yields, boost value. Come peak market, you can sell them off and sail off into the sunset and roll the capital into the next suppressed markets. Always be 3 to 5 years ahead of the mainstream, but don't get caught out with all the fear of missing out and all the masses. Until next time, thanks for watching.